Thanks for watching Lessons in Minutes with Jaylee. Like, share, and don't forget to subscribe.
The topic for this lesson is cash flow projections, right? And the objective is that at the end of the lesson, you should be able to prepare a cash flow projection within a 6 month period. So at the end of the lesson, you should be able to prepare a cash flow projection within a 6 month period. So basically, what you'd be doing is planning ahead for a 6 month period. But what is cash flow? Cash flow basically includes receipts of cash and payments of cash. So basically, that's total money transferred into and out of a business for a period. Businesses do what is called a cash flow projection. So basically, they prepare a forecast showing how cash will be generated and disposed of by them during the period, by the organization during the period. So they're matching what they would receive in terms of cash and what they would pay out in terms of cash for the period. And what they would receive would be the inflow, and what they're paying out would be the outflow for the period for the organization. But why is it that they do cash flow projections? What are the benefits of doing cash flow projections? And the main thing is that it aids them in planning ahead. Planning ahead for what? So we're going to look at one thing. Business setting up an overdraft facility with their bank where shortages are predicted. So where they predict that there is a shortage, meaning that they don't have enough cash to cover all the outflows, they can go to their bank and set up an overdraft facility. Or instead of doing the overdraft facility, they may decide to just acquire a loan for the period so that they can cover their outflows. Another is that they'll be able to put plans in place to make better use of excess funds where surpluses are predicted. So when they are too liquid, what would they put in place so that they don't fall into a liquidity problem? All right, because businesses try not to be too liquid. So in doing the cash flow projections, they can put plans in place so they can make better use of the excess fund. All right. Now, I've mentioned inflows and outflows, and inflows are basically the receipts, and the outflows are what you make as payments. But what causes receipts of cash in the business? What are the inflows? So here is a list of items that causes inflows of cash into the business, and they are cash sales, receipts from credit customers, capital introduced by the owner, grants, and also proceeds from the sale of non-current assets. And non-current assets, remember, that's your fixed assets. So if you sell like a motor vehicle, you sell machinery, you sell computer, those would cause an inflow of cash in the business. So basically, the business would receive in cash. If they generate, if they receive a loan, or if they receive loans and other revenues that the business might have acquired for the period in terms of cash. We're going to look at the outflows now. What causes cash to go out of the business? And the outflows. So here's a list of items that cause an outflow of cash, right? And that would be cash purchases. Yes, because you have to pay for the goods, right? Payments to suppliers, money is going out, expense payments, owner's drawings when the owner take cash for personal use, and also purchases of non-current assets, repayments of loans, and other expenses. Okay, so those would cause an outflow of cash. Even payment of dividend, that would be an outflow as well. So those are the inflows versus the outflows. So we're going to look at a work example. We're going to look at a work example. And it's relatively simple to do a cash flow projections. It is nothing grand. Okay, so the question reads, Jaylee owns a clothing store called Jaylee Enterprise. She prepares 6 monthly cash projections. She provided the following forecast for each of the 6 months leading up to June 30th, 2019. And the months are January, February, March, April, May, June. And you're seeing the items that would cause either an inflow or outflow, along with the value relating to each item for each month. Additional information, fixed cost, $300 per month. So you're going to find that this $300 would be running across each month because that's a cost per month. On January 1st, 2019, the business is forecast to have a bank balance of $1,400. This is important. So basically, your cash flow statement will be showing 3 parts: the inflows, the outflows, and then you'll be doing a balancing section, checking how much cash you would have at the end of the period for each month. So the first thing that we're going to start with is the cash inflows. So let's look at the cash inflows. And what would be the cash inflows? What would be the cash inflows coming from this question? So here we are. We have cash sales would be an inflow. So let's enter that, cash sales. And the amount, we're going to look at January 1st. You could go across looking at each month and then you do the balancing section at the end. But I'm going to look at January 1st and then we'll take a look at the others in the other approach. So here we are, cash sales, and the value for cash sales is $4,200. What else causes an inflow of cash? What would be a receipt of cash? The next item, receipts from debtors. So that is also an inflow of cash. So that is listed on under inflows, that is receipts from debtors. And the value that they project to receive from debtors is $6,300. Scanning the question to see if there is any other receipt. No. So therefore, we're going to total our inflows. And the total inflows would be 4,200 plus 6,300. And that gives a total of 10,500. For this section, you're going to put in your single line above and your double line below because you are finished with the inflows. So next, we're going to look at the cash outflows. And we're going to enter all those things that would cause the cash to basically decrease. And those are your payments. So we start with payments to creditors. And the payment to creditors value is 3,800. Following that would be wages, because yes, you have to pay your workers, so that is an outflow. So they're projecting that they'll pay out a value of 2,900 to the workers for January. Utilities is also an outflow. Utilities is an expense, so that is an outflow. You have to pay for that, so that's 600. Other running costs incurred by the business, those are expenses, so that would be an outflow, and that value is 1,900. So we have listed all the outflows from the table for January, but additional information provided is that each month there's a fixed cost of $300. This fixed cost is also an outflow, so we're going to make that recording in the projection. Fixed cost 300, and that is 300 per month. So you're going to find that this fixed cost will be running across the other months as well. Now that we have all our Values for the outflows, we're going to total. So that's 3,800 plus 2,900 plus 600 plus 1,900 plus 300. And that gives a total of 9,500. So this is our total outflow. Now, your next step, once you have your receipts, your total inflows, and you have your payments, which is your total outflows, we can now do a reconciliation. We can now do the balancing section to see if there is enough cash that would be in the business for the period. Now, we're going to start with your opening bank balance. So opening balance, we can call it opening bank balance, and that value is 1,400. To that, you're going to add your cash inflows, and that is 10,500. Remember, we have calculated that earlier. That's 10,500, and that would give us a total of $11,900. Now, the next thing that you're going to do is to subtract your outflows. So less cash outflows. And your cash outflows based on calculation is 9,500. So when you minus that 9,500 from the 11,900, what is remaining is 2,400. This 2,400 represents the closing bank balance. All right, so that would be the closing balance remaining in the business as it relates to cash for the period, and that is 2,400. This 2,400 would become the opening bank balance for the following month. So basically, your closing balances would become your opening balances. Okay, so let's go for February. As a matter of fact, we can just put in the figures as it relates to the items running across, and then we do our calculation. So February cash sales is 4,100. For March, we have a cash sales of 3,900. For April, they're projecting 3,400. May, that is 3,200. And for June, that is 3,000. Receipts from debtors, running across again, that's 6,000. For February, March, 6,500. For April, we're seeing 6,100. For May, that is 6,600. And for June, we have 6,200. Your next step would be to ascertain the total inflows for each month. So for February, that is 4,100 plus 6,000, that would give 10,100. For March, that is 3,900 plus 6,500, and that gives a value of 10,400. For April, 3,400 plus 6,100, that gives us a total of 9,500. For May, 3,200 plus 6,600 give us 9,800. So what we're doing here is just to total the cash inflows for each month. So we're adding all the receipts together to get our total inflows for each month. For June, we have 3,000 and we have 6,200, so that would give us 9,200. Okay, so now that we have our total inflows, we can just put in our outflows, and we begin with the payments to creditors, and we're starting with February. Remember, we did January already, so we'll pick up the 4,300 for February. For March, that is 4,800. For April, 4,700. For May, 4,600. And for June, that's 4,100. Wages, remember that is an outflow as well. We did for January. We're going to pick up for February running down to June. So here we are. These are the figures that we'll be working with. So for wages, February, that's 2,800. March, 2,700. For April, that's 2,900. May, 2,700 is a projection to be paid out for wages. And for June, that is 2,800. Utilities for the period from February down to June, we're going to record those now. And that is 600 for February, 700 for March. We see April, the same value as March, that is 700. For May, they're projecting that utilities would be 900. And for June, that is 800 as projection. Other running costs from February down to June, 2,200. We have for March, 3,400. April, that's 2,500. And May, 1,800. And for June, that is 1,300. As I said earlier, doing the cash flow projections is nothing that is difficult. It's relatively easy, right? So we're going to, the final thing is the fixed cost. And remember, the fixed cost is the same value that would spread across for each month, and that is 300. So we're going to enter 300 for each month. This cost doesn't change, so it remains, as it said, fixed. So we're entering that 300 for each month. So now that we have entered all the outflows, we can now put in our totals for each month going across as it relates for the outflows. So we begin with February, 4,300 plus 2,800. Ensure that you put in the right figures. We have 600 there, 2,200, and 300. So that gives us a total of 10,200. For March, you're adding payments to creditors down to fixed costs, all of these figures, and that would give you a total of 11,900. For April, or total, adding up all of these figures, or total is 11,100. For May, the total is 9,500. And for June, that is 9,300. So those are the total outflows for each month. So our final step now is to do the last section, which is the balancing section. You're basically checking what you have in terms of total inflows, and you're subtracting your outflows to get your closing balance. So remember, your closing balance from the previous month will become your opening balance for the next month. So here we are. The closing balance from January is 2,400, so that becomes the opening balance for February, which is 2,400. To that, you're going to add the cash inflows from February, which is 10,100. And when you add that value to the 2,400, you get a total of 12,500. Your next step is to subtract your outflows, your total outflows, and that is 10,200. 10,200 from the 12,500 give you a remaining balance of $2,300. So that is the closing balance for February. So remember, your closing balance from the previous period becomes your opening balance for the next period. So that is the 2,400 plus the total inflows minus the outflows give you the closing balance. So let us do for March. So for March, the closing bank balance coming from February becomes the openings, that is 2,300. To that 2,300, you're going to add the inflow of 10,400. And that gives us a value of 12,700. From that, we are going to subtract 11,900, which is the total outflow. So that's 12,700 minus 11,900, and that gives a value of $800. This $800 becomes the opening balance for April. So we'll start with the 800. To that, we are going to add the 9,500, which is the total inflows. That's the total receipts, basically. And that gives us a total of 10,300. Now, this 10,300, you're going to minus the total outflows from that. So that would be 11,100. And that is going to give us a negative. And that's negative 800. Now, the negatives, you put them in brackets, and once this negative, it means that your outflows will be greater than your inflows. And this means that because there is a shortage of cash, the business can then proceed to acquire a loan within time, or they can, as indicated earlier, they can set up an overdraft facility with their bank so that they will be able to cover their payments for the period of April. Because that figure is negative, we're going to start off May with that same negative 800. So remember, you're working with a negative figure. And to that, we're going to add 9,800. That would give us a value of $9,000. That 9,000, we're going to subtract the outflows from that, and the outflows again is greater than what we have, and that would give us a negative 500. So when we start the next period, you would notice that, again, remember, your closing balance becomes your opening. So we are starting with negative 500 for June. To that, we're going to add the inflows of 9,200, and that inflow added to the negative 500 would give us 8,700. That 8,700. Now we're going to subtract our outflows. And again, our outflows is greater than what we have in receipts. So that's 9,300. And the difference between those two figures of 8,700 and the 9,300 give us a negative 600. So what you would notice is that for the periods from April down to June, there is a projection that the business will not have enough cash. And once they projected that they don't have enough cash to cover their outflows, then they can set up the facility of the overdraft with their bank. Or again, remember, they can seek a loan, or is a possibility that they would have to review all those outflows and see where they can cut back. Or what they can do is try to increase their inflows, find ways to increase their inflows. So they can increase their selling price, for example, to increase their inflows. Okay, so as I said earlier, it's not a grand thing in doing your cash flow projection, meaning it's not hard to do your cash flow projections. Remember, there are three sections: your cash inflows, that's your cash inflows, which are your receipts, ways in which the money will come into the business, your outflows, which are your payments, what causes the money to leave the business, basically, and your balancing section. Remember, for your balancing section, you're adding your inflows, you're subtracting your outflows, and that would give you your closing balance for a month. The closing balance for the previous period becomes the opening balance for the next period or the current period, basically. And that is how you would continue throughout the process of doing your cash flow projections. In exam, they may ask you to do just for 3 months, right? But as can be seen in the January 2021 exam, the question was just for 3 months, for a 3 months period. But once you start off, it is nothing difficult. You can get it done. So that is it for cash flow projections. And again, it's nothing difficult.
Like, share, and don't forget to subscribe.